Today, we will be having some stock counter updates with our Phillip on the ground on SPH and Starhub. And in terms of macro sector outlook, we do have our Singapore Banking Monthly for April. And then we will also be going through our second quarter strategy stock picks, as well as the SG Weekly for week 14. And without further ado, let us begin with our SG Banking Monthly for April. Okay, first of all, we are maintaining our overweight call in the sector. If you take a look at the interest rates are actually up 11 basis points year to date to about 0.42% on average. This you can see on the tape graph on the left hand side. You can see that the dark blue and the light blue lines have actually moved slightly upwards a little bit. And nevertheless, if you take a look in the context of the past 5 years and even longer, actually the interest rates are still much lower compared to historical levels, and even compared to just last year, the current rates are about 53 basis points lower. So what we do expect is that in the short term, margins pressure will still be around. So for financial year 2021, NIMs will probably come in around 1.45% to 1.55%, which is going to be lower than the 1.6% that we observed across three banks in 2020 itself. In terms of loans growth actually extended their recovery in February. It grew on a month-on-month basis. Just take note, the recovery is considered on a month-on-month basis and not on a year-on-year basis, because year-on-year, the decline is still about 0.88%, but this has narrowed over the past few months. And for business and consumer loans, they grew at 0.48 and 0.42% respectively. But what is important to note, if you take a look at the light blue line for the graph on the left-hand side, I can see that actually consumer loans marked their first growth. They actually turned positive, plus 0.1% year-on-year, just a little bit. But it is the first growth since April 2019. So it has been a while since the consumer loans have been declining as well. So, however, with the brightening of economic outlook, apart from the fact that Singapore loans are recovering, we are expecting the local banks to see benefit coming from their presence in North Asia and Southeast Asia, with all the trade flows between the region, within the region, as well as the rollout of vaccination programs, which will kind of push the pedal on the pace of recovery of these regional economies. However, if you take a look at the market activities for SDAV and DDAV, so the securities and the derivatives turnover, it kind of fell in March. For preliminary, the SDAV that we got from Bloomberg, we actually saw that it was about 1.6 billion per day, which is actually the third highest historically. However, year on year, it is down 26%, because just 1 year ago, we saw that there was the height of the sell-off due to the COVID-19 situation a year ago, which was actually the historical high. So despite this being the third highest, it is still 26% lower. In terms of the derivatives, the equity derivative side of things, we see that top 5 equity derivatives fell 32.1%. So of course, compared to year on year, also just last year, it was the height of the sell-off. So this year compared to then, the volatility is like probably 1/4 or half. If you take a look at the VIX index itself, it's probably 1/4 or half of what you saw last year. So the fact that there was a much lower demand for derivatives during this period as a hedging tool is also what affected the derivatives turnover. So in terms of the entire third quarter, if you take a look at January to March, the period between January to March, if you look at the table on the top left-hand corner, you see that actually we see that the entire third quarter securities value is probably down, and is down about 7%. And for derivatives, we do not know the final number, but it's probably going to be down as well. So the income for SGX will probably slide up to 10% year on year due to a high base effect from a year ago. But moving forward, it is expected to normalize. So in terms of recommendation, we are maintaining our overweight, like I mentioned at the start. And currently, if you take a look at the table on the left-hand side, the bottom left-hand side, you can see that our the banks are currently trading within a band of about 1.06 times to 1.35 times. This is kind of close to our targeted book value of 1.17 to 1.31 times. And over the past 5 years, you can actually see on the table on the top left, they have actually traded above 1.4 times before. So there is still upside, especially with how things are looking better. And we were expecting the higher price to book values to be supported by improving ROEs. And also, secondly, we see that they have maintained a very strong capital ratio despite coming out of COVID-19. Their CET1 ratios have all improved. Now it's currently standing at 13.9% to 15.2%, which is much higher than their 12.5 to 13.5% ideal operating range. The banks want to maintain a good enough CET1 level, but not too high, because otherwise it will take a toll on their ROEs as well. So within the sector, we are preferring OCBC, which we expect a faster booking of their earnings growth due to their wealth management and their insurance franchises during this economic recovery period. And that's it for me for Singapore Banking Monthly. I'll now hand the time over to Timothy, who will be talking about Phillip on the ground for SPH.
Yeah, thanks, Yu Guang. Next slide, please. Okay, just a summary of SPH first half 21 results. On the top left-hand corner of the table, so most of their segments actually improved, except the media, which was loss-making if you take out the job support scheme. And so the media lost about 9.7 million, but for the property, PBSA, and the aged care, they all improved. So for media, revenue was down 23.9%, but this is due to the structural decline in the industry for advertising. But there was a strategic review announced. So should the media business be separated from the rest of the businesses, it should remove the overhang from the other businesses. For retail side, profit before tax was up 9.7%. This was due to the acquisition of Westfield Marion. And for PBSA, purpose-built student accommodation, profit before tax rose 266%. This was also due to acquisition of Student Castle in December 2019. So the bookings for the student accommodations has been, they still see demand from Chinese students. So they achieved 28% of the target revenue for academic year 2021 and 2022. For the sale of their Woodleigh residences, the sale is still going strong. So the prices are still above 2K per square feet for the units sold since November 2020. SPH reviewed more of their assets that they are holding in the recent update. So for the investments that they hold, they actually hold 0.1% in Kopang, which is the owner of Q10, which is like the Amazon of Korea. So they invested about 4 million at the start, and now their stake is worth US 81 million. So they managed to gain about 28 million Sing dollars since this stock IPO in March this year. They can start to unwind this their stake from September 2021 onwards. And for the stake, they also have a 40% stake in a Genting Lane data center of 932 million GDV, assuming a 5% yield that this data center is still under development. So assuming a 5% yield on this GDV, this will translate to about 18 million NPI per annum, or about 13% of FY20 profit before tax. So the table on the right, it shows the assets that SPH owns at the moment. The total assets is 9.1 billion. So they reviewed more of the assets that they own under the digital and the treasury segments. So they actually own 16% of N1 also, 15% stake in iFast, and a 6.7% stake in Prime US REIT. So this translates to a price to book of 0.74, which is still at a historical low level if you look at the table in the middle. That's all for SPH. Pass my time on to Natalie. Oh, Paul, sorry.
Thanks, Timothy. I will move on to our Singapore strategy, but we won't run through the whole slide deck because it will take too long. We'll just focus on the stock picks that we presented on Saturday. Just to refresh, I think we issued our strategy report. Again, we tried to keep it very short. It was released last Thursday. And the title is basically what we're just trying to say is that whilst economic momentum is picking up, we see that across even in commodity prices and of course manufacturing and so forth. But in terms of worries of inflation, although economic momentum is picking up and will accelerate further because all this is even rising before the Biden's recent stimulus. What the Federal Reserve is saying is that even if you do see any inflation, don't worry about it. It's only going to be temporary. And that is the gist of why we titled the report "Music is Still Playing," because that's what we're just trying to relay is that the Fed is still saying, don't worry about the inflation numbers. It is just temporary. So that's why there will be no tightening, at least on the monetary policy side. Okay, move on to the next slide. Okay, in terms of our model portfolio, the numbers were not good. If you look at the table on the right, you can see the performance. We were down considering that the market was up 11%. And we always like to give a quote of our performance. And if we were a fund manager, this time you can read at the below. If we were a fund manager and we visit our clients, I think the clients will let the guard dogs out. So what happened was that Yoma was a big detriment to our portfolio. I think it was down 50%. So that took a big bite of our performance. The other part where we didn't do well, as the title of the table on the left shows, that we lacked cyclicals and we had a lot of yield stocks because we always try to balance the portfolio. So you can see that the yield, the Escort, Asian PTV all underperformed year to date, which is the 3 months. What did well for us was Propnex and also CapitaLand. For the changes that we made, we removed Yoma and also we added QNM. Okay, next slide. I think most of you probably hear me keep on repeating this story, but I guess you have to bear the next 1 or 2 more minutes. But anyway, for Asian Pay TV, for refresh, what they do is they are a monopoly cable provider in 4 counties in Taiwan. The subscribers are stable, although Pay TV subscribers are coming up, but the broadband is growing. So in total, the number of subscribers is stable. So there are 2 reasons why we are positive. I think the table on the left, as you can see, in the early years from 2014 to 2018, dividends was not sustainable. I think you can see from the red line, dividends was ranging, let's say 100 plus million, but the amount of free cash flow they generated was less than 50 or even less than 40. So that all came to roost in 2019 when you can see the red bar, which is dividends collapse. So they collapsed dividends in 2019. But on the flip side, the positive is that it made it more sustainable. So there's enough free cash flow to actually this time cover the dividends. And as you can see from the blue line, dividends now, free cash flow now is far higher than the dividends. And one of the reasons is the amount of capex. As you can see from 2016, the orange line, capex was as high as 100 million. But the problem was there was limited or actually virtually no returns on the capex. They virtually had to give an extra set-top box, but no one's going to pay more for that because it was kind of like a regulatory requirement. So just to cut short, the 2 reasons we are positive is the sustainable free cash flow, 65 million. And as we highlighted in our presentation, we are using free cash flow. We intentionally put the word not EBITDA just to remind everyone that EBITDA is not cash, because EBITDA assumes you don't have to pay tax and you don't have to pay interest rate. So you can imagine try not to paying your banker and not paying the government, what's going to happen. So we just want to reinforce that we are using free cash flow, which is after capex, after tax and everything, versus the 18 million dividend that they've committed, which is 1 cent. The other part is the optionality. Again, the timing should be this year, maybe late last year, because they don't really give details and they are not allowed to because it's a bit forward statement. But we think our numbers don't include the 5G. And so the yield is about 9% right now. So there's some optionality that is not priced in on the 5G upside. Okay, next slide. If you go to ComfortDelGro, the table on the left is just to show you the taxi fleet. If you focus on May, April or May, you can see the taxi fleet really collapsed during the circuit breaker. The one thing positive now, I guess, is that the fleet is a bit more stable right now, the Singapore taxi fleet. And if they move more to hybrid, the returns are higher for Comfort because the rental rates are higher and because the drivers have petrol savings, so they don't mind paying. But anyway, you go back to the bullet points. One of the reasons why we like it is that the pandemic didn't hurt the balance sheet. Actually, the pandemic kind of like improved their balance sheet. Their free cash flow actually jumped to 500. Their net cash also was higher. Part of the reason is they lowered capex and also they had some government subsidies. The second bullet point, the new real financing framework. If that happens, again, even if they do disclose, there's very little details given to the analysts because these are all confidential. But the main thing is that it will reduce the ridership risk for SBS Transfit, the downtown line and so forth. What happens is that so you are just paid a fee, you don't have to take on the assets, and the government, you're just paid a fee to operate. Of course, there's less upside, but these days rail, there is no upside. On the third bullet point, the other part why we like it is that we like the rental model, and we like the 60% market share that they have, and also we like the kind of rental model. Both is kind of like taxi and bus, you don't really take ridership risk. Taxi, you're just renting it out, and of course the hybrid taxi I mentioned have higher returns. And also we think Australia and UK profitability will recover. But of course the disclaimer is that Grab is still a formidable competitor. I mean, they're loss-making and they can still compete you. So no, it's very hard to compete with someone that's loss-making. Yeah. So that is the thing that ours is just that it's a transport recovery proxy for us. Next slide. If you go to Prognex, I think we know who Prognex is. I think, but the table on the left, it just shows the total transactions, both new and resale. So we combine both because ultimately they depend on both, and of course HDB, but we didn't put that in, otherwise the numbers will just go through the roof. So this is just the private transactions. Last year you can see it was stable around 20,000. You can roughly assume half. I mean, new is 10,000 and resale is 10. And the transactions, the first bullet point was resilient despite we entered into at least a technical recession. And the second bullet point is that we like it because they got a huge market share. I mean, like we said, very few industries have such a large market share. And they have very attractive 33% ROE, 105 million net cash. The drivers for growth in terms of volume for 2021 will be resale. New launches will be slower. It will be stable, maybe low single digit, and likewise for HDB. So our ratings are buy at $1 target price. Next slide. Okay, in terms of Q&M, the table on the left just shows the number of clinics. If you look at, let's say, 2015 to 2016, they hardly grew their clinics. Even 2018, maybe 5 to 6 clinics. It was only in 2019 that you see this big pickup in clinics by 10, 11. 2020, the 117, of course, was pandemic hit. So they couldn't really open, obviously, or everything was shut down. So what we think, part of our growth drivers, or at least the investment thesis, is that 2021, 2022, you see this big jump in clinics. So they will grow their clinics by around 22% CAGR per year. That means 22% per year. And this will give them at least some baseline growth rate because of the organic growth. The good thing about clinics is that it's sustainable. I think once you open, I mean, you're not going to shut them down. And you have the brand name, and then you have the location, and the dentists are willing to accept this kind of model where they share 50%, so that they don't have to spend their time, on administration, on trying to look. As you know, dentistry, you can't advertise. So if you have a brand name, some prefer this brand name and then just focus on doing procedures. And also K&M has allocated more recruitment. They've created a new department, a huge department, just to recruit the dentists and to roll out this targeted 20% kind of growth. The third bullet point, just that the lockdown has actually improved visitations. I guess everyone is stuck here, so there is more traffic. And also the dentists are stuck here, so the dentists have to do more. I mean, the utilization by dentists is higher because they are also stuck here. The fourth bullet point is that the new growth driver is COVID PCR testing. Both the sale of the test kits itself, they make money because they own the test kits, the IP to the test kits, and also they will do the lab testing. In terms of, we had a question earlier in another session of whether the PCR test will happen even with vaccination. It will. I think so far, what concerns the authorities is the new variants of even if everyone is vaccinated in Singapore, what if there are new variants? So the authorities are worried and they are still continuing to do tests. And the second thing is that there's still uncertainty how long the immune system will be after vaccination. And also, it's also a bit also unclear whether once you vaccinated, whether can you still carry the virus. Although some studies have shown you won't, but again, the authorities here are a bit more conservative. They cannot afford another breakout. So this testing will continue definitely for this year, and it seems to be accelerating. And next slide. I think that's it for me. Okay, hand it over to Jamie. Thanks.
Okay, thanks, Paul. Yeah, so next we have first sponsor, and just a brief intro. First sponsor is a developer, owner, and financier of property projects. Its key revenue contributor comes from property development, and its main operations are in China and Europe. So just on the first bullet point, its two key stakeholders, CDL and TAITAC, actually owns 80% of first sponsor. Both are recognized property holding companies in Asia. And also, like the title, first sponsor does property development, property holdings, and property financing. So we actually like that it captures the full entire value chain in terms of property development. So the next bullet point, starting with the property financing business, we like that. We like the high recurring income coming from the property financing business. So if you look at the chart on the left, we're actually expecting an 18% growth in loan book and revenue for FY21. The double-digit growth in loan book is due to the high demand for credit for alternative. The double-digit growth in loan book is due to the high demand for alternative sources of credit in the property development market. This is because of the tightening credit market in China. So these loans are actually charged at low to mid-teens interest rates. Okay, then the next point, the main thing to know about the property development segment is that the Greater Bay Area, specifically Dongguan, the key market that first sponsor operates in, actually saw high demand for its property such that most of its residential projects are sold out shortly after launch. So interested buyers were actually paying money just to queue up for a chance to purchase the properties. Their revenue is recognized upon handover. As such, it owns more than 900 million worth of revenue that has yet to be recognized. In 4Q20, first sponsor took on 2 new projects, one in the Greater Bay Area, one in Dongguan. So with this inclusion, its existing projects provide for a gross development value of more than 4 billion. Now for the last point, for the last point, property holdings. First sponsors hotels are located in the parts of Europe where hotels actually saw a greater recovery in August, boosted by the demand for staycations. However, Netherlands has seen a resurgence of COVID-19 cases in September, and now again a third wave since February. The property holding segment comprises both hotels and office. So FY20's contribution actually saw gross profit fall to 5%. As compared to, gross profit margins fall to 5% as compared to 16% in FY19. This is partially supported by the office segment that is still resilient during this period of time. We are still expecting a standard recovery for the hotel portfolio. So overall, our call for first sponsor is a buy at a target price of $1.56. Next. Okay, so next will be our new initiation on Pan United. And just a brief intro, Pan United is the largest provider of ready-mix concrete and cement in Singapore. It's a market leader in Singapore with approximately 40% market share. Concrete and cement contributes about 95% to FY20's revenue. So first of all, and also the main story for PanU is that we're expecting a recovery in the construction demand in Singapore. So if you look at the construction demand chart on your left, we are buying at the bottom of the cycle. We are expecting 2021 construction demand to improve by as much as 31%, led by public residential and civil engineering projects. So these projects actually include projects like your Jurong region and Cross Island MRT lines. Further ahead, we should still see a steady improvement from 2021 levels. This will be boosted by more public sector projects. So we are expecting PanU to benefit from this, given its roughly 40% market share over the past 5 to 6 years. Next, we do see some trade barriers to entry. So apart from having dominant players in the market, silo facilities are also limited due to land constraints. Due to environmental reasons, batching plants have also gone up in prices in recent years. So just for you to know, PanU has their own cement silos as well as stack producers and RMC batching plants. We like that PanU has invested in every part of its raw material supply chain and actually obtains most of its imported materials, mainly cement, from its strategic partners, which actually makes the supply chain even more resilient. So the last point, moving downstream, PanU owns or manages virtually all the components and processes along the concrete value chain, from innovation and production of concrete to delivery to customers. So just to give you some context, concrete products should actually reach customers within 2 hours of delivery. So an efficient downstream delivery system is actually important. PenU uses their in-house technologies like AIR, which is their concrete management platform, and also Go Truck, their truck hauling platform, to streamline day-to-day operations and also transport materials without owning a single truck. So we actually believe that these innovations give PenU its competitive edge, it makes its operations more efficient and results in cost savings and also better service standards. So all in all, our call for PenU is to buy with a target price of 40 cents. Yeah. Now I'll pass on my time to Wee Kwang for IX Biopharma.
Thank you, Jie Hui. So now I'll be talking about IX Biopharma. Basically, IX Biopharma, they actually built their entire brand around their Waferix technology, which is the main technology behind their whole entire company itself. So it is a sublingual delivery system. So you can take a look at IX Biopharma as a drug maker with this IP that they have that is very different from the typical drug makers that you see. So usually other drug makers, what they do is they actually, when they are coming up with new products, they actually have to test a new molecule, like an active ingredient in their drugs. And usually this kind of drug making process has a very low success rate, first of all, and it takes a very long time before an actual product is actually brought out into the market. However, for IX Biopharma, because they are operating with the Waferix technology that is actually just like a platform, what they do is they actually use active drug ingredients that have already been tested and proven before, and then incorporating it through their Waferix technology to come up with a new drug that is actually more efficient in terms of delivery and making more efficient and more effective as a drug itself. And this helps to shorten the the research and development process for these drugs. And what we see is they actually came up, I think first of all is their wafer seal and seal cap, which is the active ingredient in Viagra. So the sildenafil. Yep. And what they have in their pipeline right now is 2 blockbuster drugs, which is Wafermin, ketamine wafer, as well as sativa, which is a cannabis wafer. So first of all, the ketamine wafer itself had the out licensing deal for it to actually enter into phase 3 clinical trials and subsequently commercialization itself is actually put on hold for about 1 year. And because this ketamine wafer, basically they are considered blockbuster because out there in the market, there is no similar drugs out there that can do what this drug does. As such, the main question that IX Biopharma is actually facing is whether they want to rush out a deal and probably end up compromising on the size of a deal itself. But for them, what they do see is because of this novelty in the ketamine wafer itself, they are not in a rush to actually rush into a deal. So they are willing to wait out, and they know that this will still command a very high premium out there in the market. And for sativa, which is the cannabis wafer, I think a lot of us, we don't really hear much about cannabis in Singapore itself. But if you take a look overseas, the push for deregulation of cannabis is actually very strong, especially is from a grassroots level. So the regulations are trying to catch up to these deregulations pushed by the grassroots level across overseas. And so if this actually comes true, so cannabis itself, what IX Biopharma actually successfully did was they actually split up the cannabis into the CBD and THC. And this sativa actually uses CBD, which is the non-psychoactive ingredient, which means that after taking this wafer, you do not get high or you don't get intoxicated from taking the cannabis itself. And this is something that is much more efficient when you compare it to the comparables out there in the market. Usually you get an oil tinctures, which is like dripping it into your mouth, or you actually smoke it. And yeah, the medicinal effect and the effectiveness of this is just much lower compared to what sativa has. And currently this sativa is actually already being sold under in Australia itself. And if you actually strip away all these blockbuster deals, what we see is that there are other products out there, especially their nutraceuticals, which is kind of like their health supplements, is actually selling selling very, very well in China, especially with more sophisticated consumers for healthcare products, supplements. And now they are actually constrained by their manufacturing capacity. But by the end of FY 2021, which is June this year, they are expecting to see the sixfold increase in manufacturing capacity, which will help them to manage this demand and push them into profitability in the subsequent financial year. And so we have a buy rating for IX Biopharma and with a target price of 45.5 cents. And now I'll hand the time over to Natalie for FCT.
Thank you, Wee Kuang. So starting off with my first stock pick, which is Fraser Centrepoint Trust. Fraser Centrepoint Trust, just to refresh everyone's memories, currently they own 11 suburban retail malls. And these retail malls have remained resilient throughout the cycle. In 2020, if you recall, during the pandemic, the suburban malls actually outperformed the central malls, which suffered because 30% of their sales were actually from international tourists. So they remain resilient due to the recurring necessity-driven spending, and 54% of the GRI, gross rental income, is actually from tenants in the essential trade services, such as your food and beverage services, as well as your supermarkets and pharmacies. A further upside for Fraser Centrepoint Trust is the potential increase in catchment size, which will lift tenant sales. So because of permanent hybrid work arrangements, the daytime population in the catchment surrounding FCT's malls will increase, and that will lift some of the tenant sales. On top of that, if you look to the graph on your left, you see that the number of HDB units around their three largest malls, which is Causeway Point, North Point, and Waterway Point, is actually projected to increase on average about 68%. Yeah, so clearly the higher number of the larger the catchment size, the more spending is expected to actually flow to the dominant malls in the area. Thirdly, of course, the decentralization of commercial clusters in the north. So as per the government's master plan, the idea is actually to move some of the working population out of the central areas and into the heartlands. And in doing so, these commercial clusters that are created in the north will help to will actually increase the footfall to the mall. We believe that the demand for space at suburban malls will likely remain strong due to the captive population, and also that the larger dominant malls and those that are well managed by retail managers will be prioritized in the midst of retail consolidation as well as expansions. So with that, our FY21 DPU yield for FCT is 5.4%. So moving on to the next counter, which is Manulife US REIT. So for Manulife US REIT, we like Manulife because of their defensive portfolio attributes. First of all, their long WALE of 5.3 years. This compares to some of the Singapore-focused office REITs with shorter WALEs of about 3 years. And this longer WALE actually means that there's a smaller percentage of their leases that will be expiring in the coming year. So for FY21 specifically, 5.8% of GRI will be expiring. 96% of the leases in Manulife's portfolio actually come with rental escalations, averaging about 2% per annum. So these rental escalations, it could be periodic, 3-year, 5-year kind of escalations, and some of them are actually annual escalations. So on average, it's about 2% per annum. So this provides some rental growth that is actually built into the portfolio. Occupancy remains high at about 93.4% as at 4Q 2020. On top of that, Manulife's portfolio of assets are actually outperforming the market subleasing. So what is market subleasing? Market subleasing is basically if a office building is, let's say, 95% occupied, it means that 95% of the space is actually leased out to committed tenants. However, even though there's very few leases within Manulife's portfolio have break leases, that means pre-termination clauses, the tenants are actually allowed to release some of the space that they have already committed back onto the market if they should have a change of direction and they want to downsize, or they want to move towards a more remote working kind of work arrangement. So that just means that if these tenants were to do so, the space that they are releasing back onto the market will compete with Manulife's existing vacancies. So in the US, the data that came out of the US in late 2020 was that subleasing has actually spiked in the United States. However, we see that from the graph on the left, that the cities in which Manulife have assets in Atlanta, Los Angeles, New Jersey, all the way until Sacramento and Washington, DC, subleasing on average is only about 11%. And this is in comparison to other notable gateways of San Francisco, Seattle, and New York, where subleasing is actually quite high at 30%. So on top of that, the subleasing in Manulife's assets is even lower than the market average. It's at 3.3%. So in a sense, we see that there's some sort of desire to stay within the offices, and there's less risk of subleasing space competing with Manulife's current stock. On top of that, office using tenants remain resilient in FY20. A high collection rate of 99% was achieved in FY20. And not to mention that US is a mature remote working adjusted office market, and hence we expect less impact from work from home adoptions in comparison to Asian societies where working from the office is predominantly the default mode. So Manulife's DPU yield is currently about 8.1% as of current share price. And this is actually one of the higher DPU yielding stock REITs that we have under our coverage. Moving on to the next counter, which is Ascott Residence Trust. So Ascott Residence Trust is the largest hospitality REIT listed on the SGX, and they have more than 80 properties, and they are within different asset types. For example, your service residences, your business hotels, some of your rental housing. And then most recently, they have acquired a new asset class, which is PBSAs, purpose-built student accommodations. So because of this diversification in asset type, lease type, as well as geography, this actually helps to provide some stability for Ascott Residence Trust. If you look to the pie charts on the left of your screen, you see that in general, Ascott actually tries to maintain a 50-50 split between stable revenue and growth revenue. So stable revenue actually comes from two different lease types. First of all, the master leases, and second of all, the MCMGIs, which stands for management contracts with minimum guaranteed income. So these two, there's a floor income, and that provides some stability, be it good times or bad times, there will always be a base. And then there's the variable income or the growth income, which comes from the management contracts. So as we know, 2020 was not a kind year for hospitality, for the hospitality sector. We saw plummeting of occupancy rates as well as room rates. And without this master lease and MCMGI leases built into the portfolio, the impact to gross profit would have been way worse. So instead, we saw the first paragraph. Instead, we saw that the master leases and the MCMGIs were the ones that formed the bulk of the gross profit in FY20, even though the revenues from management contracts did fall. Okay, so moving forward, we believe that ART will have a potentially faster recovery than peers because 74% of their assets are actually located in countries where there are large domestic markets, such as Japan, Australia, UK, US. And as global immunization rates climb, and as we move towards a herd immunity, we believe that the domestic markets will be the one that will be more vibrant ahead of the international travel markets. So additionally, ART is also growing their portfolio of long stay assets. And as mentioned, they have recently acquired a PBSA, a student accommodation asset. And together with the rental housing, these two asset classes are actually the ones where there's a relatively long average length of stay of more than 1 year, and they are counter-cyclical to a certain extent. In 2020, these two asset types actually maintain high occupancies of 95%. Yeah. So these assets will add stability to ART's portfolio. Yeah. And even though, as mentioned, FY20 was not a kind year for hospitality counters and the hospitality sector in general, Ascott did manage to realize some some gains from disposing some of their assets. They disposed about 4 assets in FY20, and one of the assets was actually disposed at a very high 60% above book, and the gains from the divestment was actually reinvested at higher yielding assets, So just as a context, some of the exit yields was like what, 2 to 5%, and they were reinvested in higher yielding assets of about 5%. The balance sheet for Ascott remains strong. They have sufficient dry power and liquidity. So there's about 2 billion worth of debt headroom for acquisitions moving forward, and 1 billion in cash and credit facilities, which is enough to cover about 3 years of fixed cost. So with that, our DPU estimate for FY21 is about 4%, but this is not the full potential, of course, because the tourism sector is still recovering. We're expecting a DPU yield of about 5% for FY22. So moving on to the last counter, which I'll be talking about, CapitaLand Limited. So for CapitaLand, we know them to be a diversified property developer and property player, real estate player. So their assets span across the retail, commercial, industrial, and hospitality sector, as well as the development, the development of private housing. And because of the diversification across these subsectors, there's actually some stability that has been inbuilt into the portfolio. So apart from that, CapitaLand has a high proportion of recurring income. So this recurring income comes from 3 different sources. First of all, the fee income from the fund management platform, where CapitaLand actually charges a fee for the management of the REITs as well as the private funds. And second of all, the fee income coming from the management and the franchising of the lodging portfolio. Third of all, rental income coming from investment properties, from CapitaLand holding some of the investment properties like your shopping malls and your office buildings within their portfolio, and they will earn a rental income from it. So for the IP portfolio, it actually generated about 53% of total revenue for FY20. Of course, this is a smaller or lower figure as compared to a less distressed year. So in FY19, we saw that about 67% of revenue came from the IP. So another growth driver that we see for CapitaLand is, of course, they are actually aggressively trying to increase the amount of recurring fee income coming from the fund management as well as the lodging platform. So in the graph to your left, you will see the amount of AUM, which stands for assets under management, under the fund management platform. So the target is to reach 100 billion by 2024. And so by growing the funds under management, the percentage of the commissions, or rather the management fee, which is charged as a percentage of the funds under management, will also grow in tandem. Okay, so we are actually expecting a significant growth from the growth in funds under management, as well as from their lodging platform, which they intend to grow the number of keys under management from currently where they stand about 120,000 to 160,000 by FY23. So that's in 2 years' time. The second last point is the demerger, which CapitaLand has sort of initiated or proposed. And this will actually help to pivot CLIM for short, to become an asset-light and growth-focused entity. Yeah. And just as a quick summary, because CLIM will be positioned as a real estate investment management company, and real estate investment companies, or REIMs for short, they typically trade at a premium to book. So this compares to how CapitaLand was trading before, which was always at around a 20 to 30% discount to book values. Moving forward, by pivoting into a REIM, then CLIM has a potential to be re-rated and traded at a premium instead of at a discount previously. Lastly, of course, CapitaLand remains very committed to their recycling initiatives. They have committed to a 3 billion asset recycling program, where they will actually try to divest non-core assets and try to reinvest some of these proceeds into new economy assets, such as your business parks and your warehouses, that kind of new economy assets, where they actually target the tech sector tenants. So with that, our DPU is actually 2.7%, and our target price of $4.38 is slightly above the implied consideration of $4.10, which the CapitaLand actually proposes to pay out to their minority shareholders. And this is because it actually captures some of the upside from CLM being re-rated as a REIM. So that's all for me. I'll now pass the time on to Terence, who will talk about Keppel.
Yeah, thanks, Natalie. So for us, the main focus for Keppel right now is whether they manage to divest away their rig assets and the logistics unit. So you can see for Keppel during the last review, they actually split the Keppel O&M into 3 main units: operating co, rig co, and development co. We provided a bit of description below in terms of the 3 units. OpCo is developing and integrating offshore energy and infrastructure assets. RigCo is to put the completed rigs. These rigs are already completed, but they are not put to work now. So this work, they try to put these rigs to work or just to completely divest them. Then DevCo is a more transient entity, is to put is to develop the rigs that are under construction now. Then once it's completed, they will transfer these rigs to RigCo. So the thinking now is once they finish building the rigs, then development co, they will just dissolve development co and just have 2 entities, operating co and rig co, and then they just try to sell rig co off. So the idea now is to transition Keppel away from the rig building business into an asset-like business with a 15% target ROE for the group. We think if they manage to sell the rig co and the logistics unit, it will be a positive catalyst for the group, because these 2 units are really the laggards in the whole entire Keppel Corporation group. So these 2 are the main focus for investors at this moment. So our target price is actually based on sum of the parts because of Keppel's conglomerate, because Keppel is conglomerate. And so we attached a 10% holding co-discount on the group. We value their O&M unit at 0.6 times book value, which is a discount to their peers. The property segment is valued at 40% discount to their RNAV, and then the infrastructure M1 business at 12 times FY21 earnings, which is mostly in line. And then the Sino-Singapore Tianjin Eco-City project at 1.5 times book value. So our target price of $6.12 actually is just 1 time of the FY21 book value, which is where they roughly trade at. So we reiterate our buy call and our target price of $6.12. That's all from me for Keppel. I'll just pass on the time to Paul to wrap up the SG Weekly. Paul, over.
Yeah, thanks. And next slide. As usual, we'll just run through some of the macro highlights for the week. In Singapore, what we had was the hospitality or hotel numbers. I think we all know it's bad, and it's pretty obvious, but just to put some numbers behind it, the RevPAR, you can assume RevPAR is roughly like revenue. It's about $60 in February. Pre-COVID, it was $192. So you can see the damage. And last year, even with the pandemic, it was 80. So the current RevPAR is still lower than the average for last year. We had the private residential prices released for the first quarter by URA. It was up 3% quarter on quarter. So for over the past 12 months, year on year, the number is 6%. So it is a bit worrying because it's quite precariously close to the, just to refresh them, before we had the last cooling measure in July 2018, where ABSD was raised and other elements. What happened was the property price was up almost 9% over a 12-month period. I mean, second quarter 17 to second quarter. So if you based on the current trajectory, we could hit those levels if we get another 3% or more increase on the second quarter. So there is a risk. Again, from what the real estate agents are saying is that they may not raise the ABSD, but they might just tweak a bit on the TDSR. I mean, we are not certain, but the next quarter, if we increase, then the risk is higher. So right now, it seems to be like it's going to cross that so-called 9% over 1 year. The other things that came out were a lot of good economic data coming out from the US. The payroll numbers was 916 against 600. But I think from the Fed's point of view, it is still 8.4 million before the pandemic. So before the pandemic, until now, we still are down 8.4 million jobs. I mean, that's what the commentary is always from the Fed. And also unemployment at 6% is below their target of around maybe 3.5 to 4, although it's not explicitly mentioned. Manufacturing was really good. I think for the US, it's like an incredible 17-year high in terms of new orders. Globally, is because the data set isn't so far because it's licensed. But it so far is still much higher than the pre-pandemic levels, which is about 50, and then the currently is about 55. I mean, just to give some numbers. We touched a bit on the Starhub's polling webinar that we had last week. So technically, we're still positive on equities. Economic momentum is basically accelerating, and now you have hopes of an infrastructure stimulus. In terms of events, we have a Zoom video. This is not a webinar using Zoom. This is the Zoom company itself. So it's almost like it's like our first US Lisco webinar, which was arranged by our US analysts. So it's of course, but of course it is going to be at night, 7:30 on the 12th April. So if you're interested, do sign up for that. Next slide. I won't go through so much. I think it's not well known, but the thing I guess right now is that there's another wave coming. Hopefully, it's not another major wave underway, but we do see certain countries still in lockdown. Even Japan is talking about it, or is undergoing it. Thanks. Next slide. I think this one nothing much. Just to shoot. This is just the amount of people being fully vaccinated. I think the key one is the one in the middle, the United States. You can see that next couple of months they could actually vaccinate everyone in their whole country. So it's going to be quite a bit of a test case. What are they going to do? What happens after that? But anyway, they are very advanced in the vaccination. Next slide. Singapore, I think we'll skip. I think it's more or less the same trend. Next slide. In terms of the employment number, just to give you some flavor, it's not going to affect your decision making, but just to give you some numbers. As you can see, during the pandemic, US lost 1.7, then another 20 million. It has recovered, maybe of course up to 8 million. So there's still another 8 million of jobs that have not fully recovered. So in a way, this is why the Fed will kind of stay off and not tighten monetary policy because of this. And also the unemployment, like we mentioned, is below their so-called maximum employment target, if you were to tag one to it. Next slide. In terms of I think we did explain it, but just to show you graphically, I think the blue line, you can see it's far higher than even pre-pandemic. And also the one on the right is the US new orders. So it's like a bit of a leading indicator of manufacturing activity. And you can see it's going to cross it could even go above the 204, 205 kind of highs. Next slide. Okay, this is the Starhub thing. I think I won't go through, you can kind of read it, but some of the key things that were discussed is, of course, roaming is the big damage to their earnings because the borders are closed. But in terms of roaming, just to add more color into it, Malaysia is the big one. Malaysia accounts for more than 20% of roaming revenue. So I think if Malaysia opens up, it's important for us to notice that if Malaysia do open up, then at least the roaming revenue can recover 1/5 of whatever has been lost in the way. And then TPG, the impact of TPG is maybe, well, he just said that maybe the most price sensitive customers will be impacted. Then the other thing is just 5G, I think. The full standalone means they'll build their own network. So full 5G will only happen in end 2025. By the end of next year, you get some 50% coverage. I think the rest I won't go through too much. I think it'll be kind of self-explanatory. I think we can just skip this and then just go to Q&A. Next slide. I think that's the last one. Okay, thanks everyone. I think we can just go straight to Q&A. Thank you for listening in, everyone. First on property, Natalie, you want to do it? Or?
The first question is, if there's property cooling measures, how would it impact the stock price of property developers and brokers like Propnex things? Okay, so the likelihood of property cooling measures, if you saw the first quarter 2021 data, as a whole, the private property index actually increased by about 2.9%. That brings the year-on-year increase to about 6%, and definitely edges us closer towards the likelihood of additional cooling measures. And if that were to happen, I think it will likely come in the by way of preventing it, not really to affect, as in it will be calibrated such that it will not really affect first-time property buyers, but more of those that have multiple properties or are trying to have more than one properties. That said, we believe that it will likely come from tweaking the, for example, loan to value ratios or the ABSD, and not so much to affect the first-time buyers. That said, of course, the tapering of such cooling measures will be targeted at preventing too fast an appreciation of the property prices, and that might affect the selling prices at which the developers can actually offload their assets or their units. So in the long run, of course, that will impact the margins for the developers. And for PropNex, I don't really think that because it is on a percentage of the value of the asset being sold, or the residential unit being sold. So I think that will not really affect the property, the real estate agents as much as it will affect the developers. Paul, you might want to touch on this for PropNex.
Yeah, and just to dial back on the developers, you can also understand why they sometimes trade at a book at a discount. I mean, even when there is no room for them to get really good margins, I think whenever that's when they're about to get some nice margins, starting to sell their properties well, then there's cooling measures. So I think maybe that's one of the reasons why a lot of these developers are trading at below book, because you can never carve out any really in a way kind of good returns. For PropNex, it will impact, you will get the knee-jerk reaction. If there is really cooling measures, you probably get 1 or 2 quarters of very bad results. Because probably there's like a bit of paralysis in the near term because nobody buys the usual thing. Then it will just bounce back. And historically, there is still a base. If you look at, I don't have the chart here, but if you look at historically, even during the worst times, you still get like 7,000 a year. So there is still a base run rate, not like totally zero. So so you will get this weakness, and of course it's going to affect the earnings. So the only drawback for PropNex is 2 things. I think number one is domestic, it's very domestic oriented, and you only got 50% market share. So that's one thing. The other thing is, of course, you will be riding with the cycle. But of course, if there's the advantage of this is that if there's a big sell down, then there's your opportunity. But definitely impact them in the near term. I mean, just to go straight to the point. In terms of the next question, would the PCR test business of Q&M still expected to contribute significantly to the bottom line? Or when SG achieved this very long COVID herd immunity? Also, it seems there are many competitors in PCR testing. NTU has developed rapid test 10 times more accurate than antigen test. Would it impact? If you look at the press, the recent press, even in the newspaper, the authorities have mentioned that they're going to ramp testing even more from right now. I think testing is part of their strategy. For this year, yes, and even next year. But I think, of course, in the year after that, we can never say that. But like we mentioned, to them they view it differently. I mean, the way we read it and the way the companies told us that it seems that the authorities do not want to take any risk at all. So testing is still going to happen. Again, like we mentioned, they are very worried of new variants. They're very worried of the length of the immunity, and they're also worried about even if you're vaccinated, can you pass it on? This thing about antigen, I think they will still prefer PCR. This is Singapore, right? I mean, they want the best. So PCR is still the gold standard. So antigen is good for events, but not for this. And antigen, the money from antigen, I mean, when I speak to companies, it's not really that attractive. So they rather do PCR. There is competition. So just to go back, because there are many parts to this question. There is competition, but the competition is mainly on the test kit. I think if you go to the MOH website, there's a lot of test kit. There's, I don't know, 20, 30, if I'm not mistaken. I can't remember. But the actual lab testing is the tough one, tough to do. I think in the private sector, there could be only 10 lab companies that are allowed to do lab testing. Like I mentioned, it's hard to do because of the type of testing you're doing, because you're doing genetic testing. And also, it's very contagious. I think I mentioned this before, so sorry for repeating. So for at least for this year, we're not worried, and the government just announced last month that they want to ramp up even more testing in the, especially in the dorms. That's where they target the most of the dorms. Every 2 weeks, I think a person staying in the dorm must be tested. I move on to the next piece. It seems next share price had run up quite a lot on 97 versus Phillip target 71. Since not much upside, would APAC Realty be a better buy at the current level? We dropped APAC Realty. For us, we just target on the leader. Of course, there could be some discount differential sometimes, but we'd rather just buy the leader, because assuming there's touch wood, there's some cooling measure, IPEX is going to get hit too, right? So that's why we prefer Propnex balance sheet. So that's why we we just stick to one, and I technically don't actually cover the property sector. So I'd rather just focus on the leader, and if Propnex don't move, I don't think the other one would, APEC would also move. And we prefer their lighter balance sheet. I know the fixed asset only 2 million, whereas I think APAC Realty bought some building. Okay, I think we just move on to the next. I think there's a Capital DC question. Then we move on to the SPH. Ultimately, you want to do the SPH first while Natalie gets reading.
Yep, sure. There's currently no details on the restructuring plan at the moment, so I can't add anything.
Yeah, sorry, just to add, the only, sorry to interrupt you, Timothy. So in the briefing, of course, the management was a bit sensitive. They didn't want to touch anything on the restructuring. The only thing they mentioned was that do note that SPH the ownership is controlled, so I don't think they can actually sell the media. But like Timothy said, maybe they will just hive off into a separate entity, but they cannot sell. So the shareholding cannot change for the media because it's a control thing. Yeah. Sorry, Timothy, go ahead.
Yeah, that's all.
It's the second one too, I think. Yeah, that's the second question.
Yeah, I'll take the question on Capital DC. Capital DC REIT has dropped quite a fair bit without any reason. Is this a good time to pick up some shares? Okay, so the answer to this question is yes. We currently have an accumulate call on Capital DC. We're projecting FY21 DPU yield of about 3.6%. Do take note, this is on the lower. This is the lowest DPU yield within our coverage, and I think it's justly so. Also, as we know, the data centers have recently been in the limelight again due to remote working trends, and in general just a higher adoption of cloud usage, and also the impending 5G rollout. And that said, there has been quite a bit of money chasing the data center asset class. However, with the recent decline in share prices, the total return, that means including this 3.6% DPU forecast, for Capital DC is actually about 22% based on our target price. Yeah, and we believe that this whole pandemic situation has actually accelerated the demand for, or rather the adoption of cloud, and heightened the usage of social media, etc. And that actually does work in favor for the data center owners. Within our DPU forecast, of course, we have included a acquisition of data centers. This is because Capital DC has been in talks with other third-party sellers to acquire portfolios of data centers. So just to caveat it, our TP has also embedded in some growth from acquisitions. Yeah.
Okay, for the second SPH question, it asks whether it's better to position into SPH REIT rather than SPH, since there is the media pulling it down. So the reason why I invest in SPH rather than SPH REIT is for the turnaround story. If the media portion is removed from SPH, then valuations may rise further for SPH, as the overhang from the media is no longer there. Whereas for SPH REIT, it's more like there's no change to SPH REIT, basically. Yes. So that's
they could maybe distribute in specie the non-media business, right? again, we do not know. I mean, maybe they just list one entity that holds some of the investments, some of the recurrent income in a separate entity, and just list it and then just distribute those shares to shareholders. Again, we are not sure. Just speculating and come out with any kind of model. That could be one area, so that the good assets don't get mixed up with the bad assets, then become neutral, become like neutral, or like what we saw Sembcorp Industry. So that could be one thing they're looking at. Again, we're not sure. Yeah.
Okay, hi. I see a question on first sponsor, so I'll just read out. Hi. How will first sponsor be impacted if the Chinese government is to impose measures, say within the next 1 year, to prevent the property market from overheating? So for this question, actually, the government has already rolled out measures to cool the property market since July last year by introducing additional residency and tax requirements to tighten rules on home purchases. So due to these measures, China's home prices actually grew at its lowest pace in November since March, actually grew at its slowest pace since March in November and moderately then in December. But even so, as in there's still growth. So during this same period of time, Dongguan, which is first sponsor's main market when it comes to property development, actually came out a few times as the market with the highest price increase in percentage terms. So as a round two of property cooling measures, China is now looking at the financing activity of both the developers and the buyers to prevent rampant lending growth. Yeah, so this kind of restricted bank lending to developers. In the end, developers end up looking for alternative sources of credit, which in our view actually benefited first sponsor, because first sponsor is able to lend officially and participate in their property projects. So in our view, actually, on the property development front, we think that first sponsor is well positioned in one of the hottest markets, where demand is still unrelenting despite all these cooling measures. And on the property financing side, first sponsor is actually in a position to grow due to this round two of cooling measures. So as in, just to wrap things up, I do believe that first sponsor actually will remain resilient. If let's say the Chinese government is to impose any measures say within the next 1 year. Yeah. I do see another question on first sponsor relating to, I think, the GDV, the 4.1 GDV. So just to give you a bit more color, the 4.1 GDV is actually for all the existing projects that first sponsor has right now, after accounting for their respective equity stake. So the bulk of this GDV is actually attributable to the new Panyi project that first sponsor recently took on, which is about 1 billion. And after that, there's still the Human TOD project that is about 800 million, and the Plot E of Millennium Waterfront in Chengdu, which is about 700 million. So these three projects actually make up the bulk of this 4.1 GDV. And all this, and this GDV is expected to flow through over the next couple of years. In terms of revenue, so waiting to be recognized, we are looking at about 900 million in the near term. For greater detail, you can look at my initiation report, which actually broke down in the different, I actually broke down in different projects. So, but do note that we have actually added the two new projects, Fenggang and Panyu project, that was announced in first sponsor's recent 4Q. For these two projects, we are expecting a total of about 1.2 billion in gross development value. Yeah, so this is all for first sponsor, I think.
Okay, I'll take the next question on any views on Mapletree Industrial Trust, as it will be allocating 2/3 of its AUMs to data centers. Thanks. So, of course, this for Mapletree Industrial, Mint for short, we do not cover them. However, yes, they have been aggressively acquiring data centers, especially in the United States, and that has actually helped them to sort of rebalance their portfolio in a way. So before this acquisition, a significant portion of their assets were actually within the Singapore industrial market, and a lot of it was in the flatted factory kind of asset class, which actually, if as some of you know, it is the asset class that is actually facing the most supply and therefore the most rental pressure. With this pivot, of course, it's good for Mapletree, and it helps to sort of make their portfolio more future ready. Yeah. So in a sense, in conjunction with this question, of course, Mapletree, along with other large cap industrials, the share price has actually suffered a little bit of a beating in the recent few months, and I think that this actually presents a good time to reconsider the industrial, especially the large cap industrial REITs. So taking that question, another question which is along the same vein, I guess, would be, sorry, let me find the question. Okay, I don't see the question right
now. Hi, sorry. Yes. Okay, can I take the next question on the technical? So just give me a moment while I pull out my chart on the sharing. Okay, so basically there is a sharing, or there's a question asked on Singtel and then SIA. So perhaps I will answer this both first, and then I saw some question on Hoppa and micro mechanics as well. So perhaps I will go into Singtel first. Singapore Airlines. So Singapore Airlines, you can see from our chart that is actually is on a very strong bull run. Okay. Right now, there's some sort of consolidating pattern, like this one I will consider a pattern. But whether you break up or above, we need to really need to see that the resistance at 5.69. All right, but I'm more tuned towards a rebound at 5.42 to 5.28 region before upside to target at $6. Okay, so this my view for Singapore Airlines. So for Singtel, next one. Okay, Singtel is a bit tricky. So Singtel, as you can see, that it actually has broken out of the falling wedge. Has broken out, not very strong. Okay, so but given the multiple testing, okay, at the resistance level between 2.47 to 2.52. Okay, we are expecting some sort of like a breakthrough to target the upside resistance at 2.64 to 2.69. However, I believe that this momentum is kind of weak right now for now. So as we expect some form of pullback to the support at 2.40 before a strong rebound on the upside again. Okay. All right, so the next one, the last two stocks I'll be looking at, Hoppa. Okay, Hoppa, honestly, after releasing a report, I have a second target price at $12.74. However, price has already broken all above $13. It has been trending well above the $13 psychological support level. Okay, you can see over here, this level between $12.79 to $13. However, this consolidating is some sort of telling a slowdown of momentum. Hence, I was just stay put, wait for some sort of retracement back to the $12.93, that region, before a rebound to target on the upside again. All right, so for my last one will be micromechanics. So micromechanics, you can see like the larger trend is still on the uptrend. Okay, so it has a false breakout to the secondary uptrend line before a return above the resistance at 3.18. Okay, but do take note that $3.57 to $3.50 region is a crucial resistance zone that we shall be watching. So if expect some form of pullback back to the downside, perhaps to 3.21 before resuming to the upside. Okay, and another thing to take note on the longer time frame, on the longer time period, you can expect some form of like pullback within this gap zone between the primary and the secondary trend line. This void zone represent a very good support zone. All right, so with that, I know my technical presentation. I pass on my time to my colleague. Thank you.
Okay, let me, do you have any view on the potential SPAC IPO of Grab Holdings? Or sorry, I just don't really know really no idea. Totally don't have the details. Any answer, we just speculating. Yeah, so sorry for that. Not very sure. Another question is your portfolio drop. Your portfolio drop because Yoma, because the team don't see any upside short term versus long term. Okay, so I will let Cheh Hui add on later, but it is more the huge uncertainty. I think to make a call on Yoma now, Cheh Hui has to do it on a fundamental basis. But from the fund manager point of view, I mean, they have to, if you're running the funds, you have to consider the politics of it, right, in the very near term. So the uncertainty over the politics is just why we drop it. I have no idea whether there's going to be any resolution even 6 months from now. So it's not a fundamental call, it's more of a political call, and the way things are going, like we said, every day it seems to be getting worse and worse. And then how are we to, it's such almost an impossible task for us to kind of to tell anyone what is going to happen. Whether will they, after this thing will get resolved after 1 year, then they do their elections, or will the dispute cause even more? There could be even an armed struggle. Again, all this speculation, so we really don't know. So that is why we took it out. It's more the uncertainty over the political environment. Let me just take one more, go and hand it over to Cheh Hui. Sorry, you want to add anything?
It's okay. I think Paul, you more or less covered it. As in, like, more or less is really because of like the uncertain situation right now. I think if you followed like the Myanmar news, I think right now the death toll is about 500 plus already, and as in clearly the situation escalated very very quickly since like the start of the coup. Yeah. So as in moving forward, it's very difficult to tell whether or not things will actually recover from this from this situation. So yeah, as in, I think that's the reason why we actually took it out.
Yeah, in our strategy report, we took some pains to try to explain again the investment thesis behind Yoma. Of course, Myanmar was a fast-growing country, although the COVID kind of hurt it in the near term. But the main thesis was that Yoma had a 10-year land bank. So they had a 10-year runway of development, number one. Then number two, they had a fintech business that was profitable, like doubling every year, and also Alibaba just injected, or Ant Financial just injected 30 million US into the business. And then the third reason why we like it was also because they had KFC franchise. I think we know that. Of course, the type, and also the fourth one was that the Ayala was going to inject another 100 over million at I don't know, 30-40% premium to share price. So that was our investment thesis on paper at least. But of course, when you do emerging markets like we highlighted, you sacrifice political risk. So emerging markets have higher returns, but of course you sacrifice politics and I guess rule of law. That's the flip side, and I guess we suffer from that. That was the mistake we made. Okay, I'll run through one more question, then we go to the Manulife question. Because it's addressed to me, to Paul, is heading to asset-light model a sustainable model? Example, CapitaLand, Capital. What are your key risks associated to asset-light model? Of course, if you're a tycoon, tycoons don't like asset-light. Tycoons want assets. Because they want to make the money on the asset itself. But I think things have changed. I think right now you can see a lot more value attributed by the market to asset-light. All the US companies who we're talking about, even in Hilton, you can see like company like Hilton, they have no assets at all. They just manage it and they make so much money. But of course, asset-light, the only issue with asset-light is you need scale. Asset-light means you need a lot of scale before the markets get attracted to you. And of course, CapitaLand and Capital have that scale, and also the returns are much higher. I mean, you don't have to put in money and then people just give you money. So it's the best model. Yeah. So I hope that answers it. I'm not sure if the rest can want to add on, but I'll move on to the Manulife for Natalie.
Hi. Okay, so the next question is, any idea why Manulife REIT is under selling pressure despite it having a similar portfolio to Prime US REIT? So, okay, so we cover both Manulife and Prime, and yes, they are very similar. I think the key difference here, currently both are trading at about 1x price to NAV. In terms of gearing, Manulife's gearing is higher. It's currently about 41% versus Prime's 33%, 33.5%. Yeah, so I think that is one of the more major differences. In terms of asset allocation, yes, you're right. Very similar asset allocation. I think all we can say is that at this level, we believe that Manulife is a good price to accumulate some of Manulife units. Apart from that, I think if you look at the locations in which Manulife, Prime, and even to a certain extent Keppel Pacific Oak have their assets, if you recall from my earlier presentation, I think the cities in which Manulife have assets in, the subleasing is actually one of the lowest, versus Prime has some assets, about 12% in Washington DC, as well as for Keppel Pacific Oak, a large portion, almost 40% of AUM in Seattle. So these are some of the key cities that have a very high subleasing in the market. So I mean, both Manulife and Prime, they are actually both trading at or rather they both give yields of about 8%. And I think at this point, in terms of upside, we'll say that Manulife has a bit more upside. Yeah. So there's actually no real reason. Our best guess is that the US REITs are actually they're getting some negative pressure, or rather negative side effects from the news that's coming out from US, where the subleasing is really quite concerning for some investors. I'm not sure if Jie Hui wants to add on.
I think maybe I can cover the Prime side of things, or like why, maybe on the flip side, why I think that Prime is currently trading better than that of Manulife. As in, even so, we do like both REITs lah. So maybe I'll just state out like some of the reasons. So I think on Prime side, Prime do have more assets. As in, they do have more, I think they have 12 assets as compared to that of Manulife, which has about 9. And then I guess in terms of diversification, we actually see a greater, as in a bigger, a more diversified portfolio as compared to that of Manulife. Given that, I think if I'm not wrong, Manulife actually has a concentration of 20+% in Atlanta. Yeah, and I think more or less, yeah, as in on the asset side, that's what I was thinking about.
Okay, I think to sum things up, right? Basically, we still like the US office REITs. Yeah, they are the ones that are offering one of the highest DPU yields, around your 8% level. Yeah, and in terms of portfolio resilience, they still have a relatively long WALE, and that's one of the reasons for the resilience in our view. Okay, so I think that concludes it. Another question: it seems like all REITs are at a good and attractive price rate, despite what some may see it as high already. In this case, is there any particular preference or order of preference among the REITs? Okay, so thank you for the question. In terms of subsector preference, our preference is the retail, specifically your suburban, and then followed by your industrial. Yeah, and those are the two sectors that we are overweight on, and neutral on office as well as hospitality. So for some of the REITs that we have coverage on, so for example FCT, which we covered earlier, in terms of total returns, we are projecting about 22% based on dividend yield plus upside. And for some of the counters that we like are Ascenders. So Ascenders, like as I mentioned earlier, some of the larger cap industrials, they have taken a beating in the recent months, and actually provides a very good entry point to accumulate, because these are very large and diversified industrial players. they have the ability, because of their balance sheet, the size of their balance sheet, that allows them to actually take on any opportunistic development project, or pre-commitments and then a development project, and that will actually provide some more upside because of this, and it wouldn't create much of instability or fluctuation in terms of DPUs or in terms of earnings because of their sheer size. And for both of these, for both of like Capital DC as for Ascenders, and even earlier we talked about Mapletree, these industrial players have been the ones that are aggressively trying to acquire and pivot into the new economy sectors. So meaning those that are more tech centric and accumulate more assets that cater to these new economy tenants, like your logistics, like your data centers, etc., business park, or even your suburban office areas. So the two subsectors again are the retail as well as the industrial, and even in terms of apart from Fraser Centrepoint Trust, which is the pure play suburban retail mall, even the central malls will benefit from some uplift as more working population goes back to the office, and also of course the impending relaxation of international travel that might come closer towards the end of 2021. Yeah. So that's all for me for this question. Another question: what are the risks in investing in CapitaLand amidst their demerger plans? Okay, so for CapitaLand, I think just to touch on, I think some of the parts where investors may not like so much, because it is essentially you are investing right now, and then you will be getting back a portion of it in cash, 95 cents in cash, and then after that some units in CICT. So I think some investors may not like it that they would have to then again redeploy the money that has been sort of disbursed after post-merger. But I think apart from that, we don't really see any significant risk from trading within this period. I think, of course, there has been some talk of SGX trying to go in and analyze the deal in greater detail. But from our perspective, where we stand, we feel that this deal is not detrimental to minority shareholders. In fact, I think it is positive for the minority shareholders, where they can actually realize the development, the value of the development book at 0.95 times versus how CapitaLand has been trading previously. So that aside, I think we see more upside than downside from investing in CapitaLand within this period, because going in right now, you're actually getting a stake in the new entity, which, as mentioned, REIM, real estate investment management kind of entities, they tend to trade at a premium to book, whereas right now what you're getting in at the ground floor is a one-time book. So there's actually more upside, we believe, than downside currently. So I hope that answers your question. Okay, another question here on the impact of CapitaLand's restructuring. How will it impact CICT price? All in, CapitaLand unit holders will receive about 0.155 units in CICT as part of a distribution in species, meaning that is part of the consideration, 0.155 units of CICT. In total, that is about 6% of the CapitaLand Integrated Commercial Trust, the share float. Yeah, and I think this number has been calibrated, or the management believes that it has been calibrated in such a way that it will not create too much selling pressure or too much trading volatility for CICT units. And I think we mentioned earlier in previous weeks that we believe that this might actually cause a bit of selling pressure on CICT, because some of the unit holders, some of the CapitaLand unit holders that might be receiving CICT units might not like it, like holding or be comfortable with holding a position in a retail / integrated development kind of REIT. Yeah, so in a sense, there might be some selling pressure for CICT units. Yeah. We have another interesting question actually from me. Sorry to hog the line, but I'll just take this last one from me. Is holding CapitaLand, or rather CRIM, an easy way to holding all the CapitaLand REITs, like an ETF? So I guess in a sense, yes, to a small extent, yes, because yes, the CapitaLand group or even CRIM, which eventually will hold a position in all these REITs, they have varying stakes in the REITs from 20% up to about 30+%. However, I think there's also an added component. There's an added growth component for CapitaLand as well as CRIM. The eventual, I mean, if the merger goes through, that will be the eventual listed entity. And I think that holding CRIM or CapitaLand, there will be much more upside and potential than to hold the REITs on its own. Yeah, I don't really think it's like an ETF for the REITs, but it is an interesting thought. Yeah. Okay, I'll pass the time on to Paul if he wants to take the last few questions before we end off. Oh.
Okay, what happened to Asian Pay TV from 2018, 2019 onwards, leading to the turnaround on free cash flow and lower and lower capex? Okay, what happened to them was that they were mandated by the authorities to kind of digitalize more their cable network. You can kind of like assume they are like a net link, but then after that the cable, they are like a Starhub that use cable for broadband. But then right now they've been asked to spend more on to go and build up to give everyone another free set-top box. That was roughly the situation that was faced by Asian Pay TV, roughly lah. But then you give them this, but people didn't kind of upgrade their plans, didn't pay extra. Nobody want to pay extra, and then so although the churn kind of reduced, so as a result, the capex was high. You can see the capex as high as 100 million, 80, 90 million. So the turnaround right now is mainly on the capex. So the capex was still high in October because they are preparing for the 5G. Then from then onwards, it should continue to taper down. Yeah. Okay, I hope that kind of answers. The free cash flow is more or less stable. Yeah, it didn't really no major growth or decline in terms of operating cash flow. Sorry. Is it a good time or a bad time to buy Top Glove? I think it will be a bit challenging for Top Glove. You know, this whole thing about the US banning them because of their management of workers. I think I don't want to go and, like, if I'm an investor, if I want to buy glove, I don't want to go and stress myself out for another issue which I'm not sure what's going to pan out. I'll rather just buy the others, be it in the Singapore glove makers or the Malaysian. Because this thing is, you know, unless you got some insights how the customs of US is going to decide, why trouble ourselves with that? Yeah, rather just buy, unless there's no other glove makers, since there's so many others out there, I'd rather just buy those than going to have another variable which I'm not even sure of what's going to happen. I mean, that's my own personal thoughts. Yeah. Vivian, you got anything on SunPower? What time do we need to end this, or Viren, do you?
Actually, we need to end it already.
Okay. So thanks everyone. Thanks for all your questions, and we hope to see you again next week. Thank you everyone, and have a good week ahead. Thank you. Bye.